Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And here we are with Ron Corser, CFP founder at Cornerstone Retirement Partners, Grand Rapids resource for information and a common sense approach to planning for your financial, investment, and retirement future. Ron, a lot of changes with planning with our money for our retirement this year due to the passage of the Secure Act 2.0. What do we need to know?
We need to know a lot of things. So we're gonna touch on some of the high spots. And again, ladies and gentlemen, if what we're going to talk about kind of hits a soft spot with you, or you need to have somebody help you with it, we're very willing to do that here at Cornerstone Retirement Partners. You can give us a call at 616-301-2581. That's 616-301-2581, or go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in and we'll reach out to you, provide what you need. Good information, make great decisions for your family. And also you can kind of tune into this week's program and all the other programs we've done in the past by also just going to our website and pushing on the button to get access to these things. A lot of good information we cover. And one of the reasons I want to talk about the Secure Act again is I had an interesting experience about a week and a half ago. This gentleman and his wife came in, and I initially talked to my wife, Nancy, because they're getting ready to join Medicare. And I told him it's not painful to become a ward of the state when you have Medicare. It's actually a good thing. And he kind of smiled. But he had questions, and my wife invited me into the room when they were done talking about their Medicare options. And I was really struck. I was struck by a couple things. Number one, he's been working with a very, I guess you'd call it a high-profile, well-known advisory firm, and he hasn't had a conversation with a real human being in over a year. Now, he had significant savings. He really did. And I was kind of taken back. I always have to be kind of careful and kind to people. And I asked him why he hadn't talked to his advisor, because he asked some questions that impacted them going forward. He asked questions about, what is a Roth IRA? When can you have a Roth IRA? Is he allowed to have a Roth IRA? And I asked him, why do you ask me these questions? And he said, because I just read something about it. Now, I was kind of confused in that, and I asked him, tell me more. He's never had the conversation with the advisor. He's kind of churned through some advisors when one retires or dies. He's never had the conversation about Roth money. And he has 7 figures in savings. So we were able to go through some of the highlighted parts. But what struck me, he thanked me for the information. He took a lot of notes. He was going to go back and talk to his firm about this. And I said, if you need more expertise and help, because this is what we do to help people with current tax law changes and in long-term retirement income planning, I said, give us a call. Our job is to help people. So I think I did, talking about the tax implications of Roth strategy, Roth conversions. It was kind of an eye-opener to me that in this day and age, somebody would be that left out of the loop, so to speak. So what we talk about here is important. It may not apply everything to everyone, but there are some things I think everybody should know. And if we touch on something that you are not quite familiar with or you need more information on, please give us a call, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you and help you any way we can. So what are we going to talk about? Number one, in terms of people who are in retirement or coming into retirement, they've made some changes for those things called required minimum distributions. What are they? Well, if you're saving in tax-deferred accounts, 401ks or IRAs, you get a tax deduction for the money you put in. But ultimately, the government says, you got to take some of that money out because we need to tax it Because if we don't tax it, we could, as the government, go broke and it'll be your fault. And nobody wants that kind of burden on their shoulders. So required minimum distributions, what's one of the big changes? If you have not started required distributions, your RMDs, and you're going to be 72 this year, the good news is you can actually forego taking them this year. The old rule is you have to start taking them at age 72. The new rule is you can start taking them at age 73. Why is this important? Because it gives everybody a little more planning time if they want to do Roth conversions or Roth planning, income planning for the retirement, if they're already in retirement, making changes, and dealing with the tax consequences of whatever it is they're going to do. So it's important to understand that. Now, the one caveat or the downside to all this is that if you're already taking required minimum distributions, they don't give you a break. You got to still keep taking them. So in some ways, the government giveth and the government taketh away. And we don't have any control over that. But I think it's important to understand that because it makes a great deal of difference potentially on any Roth conversion strategy you want to implement or any kind of income changes you want to make in your retirement income plan. And if these things are important, a retirement income plan, a written plan, or creating a strategy to create more Roth money, tax-free money down the road, give us a call at 616-301-2581. That's 616-301-2581. Ask for me, Ron Corser, or Nolan Gosley. We'd be more than happy to help you work through these things because it is important. It really is important to understand these changes because every change has a good side and a bad side. We can help you take advantage of the good stuff and not be kind of blindsided by the bad stuff. So give us a call, 616-301-2581. There's another change with these required minimum distributions. And it's kind of a big deal, but it doesn't come around a lot. There's a rule there that says if you have a required minimum distribution, and you fail to take it out of your IRA or 401k that you've left with a company and you're no longer employed by them, if you don't take out what you're supposed to take out, the old rule says that there's a 50% penalty. So if you own $5,000 in your requirement distribution, you would pay $2,500 and you still have to take it out to be taxed. So that's pretty onerous. Well, they've changed it. And they basically have said in some squirrely kind of money and talking, if you make this mistake and you try to fix it very quickly and honestly, we'll reduce the penalty to 25%. And maybe if you really do a good job of it, we'll just say a 10% penalty. So they're trying to ease back on it. And I think that's a good thing because every once in a while, there are mistakes made. One of the things we do at our firm when it comes to required minimum distributions is we track every client's RMD. We do that starting at the beginning of the year. Our team puts together a list of who's going to be subjected to this required minimum distribution rule and what the dollar amount is that they have to take out. So we manage this for them constantly so there's no mistakes. We haven't had a mistake in a long, long time because this is the way we look at it. We think it's that important, not to leave it to guesswork, but to know every time you come in for a review or have a conversation about it, we're on top of this and we know what you have to do. The only decision you have to make then is, when do I take this requirement distribution? And we can help with that too. So give us a call if this is of interest to you, 616-301-2581. So those are two things that have to do with IRAs. Now, this kind of goes along with if you're going to be 73, and you're in that category, there's a really great thing here. One of the things you need to understand, and this goes for anybody taking their first RMD out, you have the opportunity to postpone that required minimum distribution in the current year when you have to take it. But it's not a free lunch. What they'll do is, let's say this is the first year you have to take your requirement distribution. You can postpone it for this year, but you have to take it by April 1st of next year, 2024. That one is for 2023. You still have to take one for 2024. So you don't get to forget about it and get, grace on one. It just means if you do postpone it when you're supposed to, you have to take out 2 in 1 year. Sometimes that can be a bit of a tax issue. So it's something that we help people understand when we do tax planning for their IRMD requirements, and we can help with that. So it's an important kind of thing to do. Now, going forward, here's an interesting thing that's happened in 401k plans and other kinds of retirement plans, 403bs. They're making it possible for you to really push all of your required distributions out of these accounts, take money out, or how you put money into the employer contributions while you're still working, to put them all this year into Roth accounts. So what does that mean? This year, if you had a 401k or 403b that had a 401k or 403b Roth account, you could put your elective deferrals into the Roth account. The company, if the employer put money in, had to go in the tax deferred account. That rule has changed. Now, if your plan allows it, you can put both the employer money and your own money into the Roth accounts in a tax-free account. Why are they doing this? Well, we all know that the government's spending money like who knows what, and they're printing it faster than they can keep up with ink supply. They desperately need tax dollars. So if you postpone paying tax by putting money in a tax deferred account, they're not going to get immediate tax dollars from you. So they're trying to encourage everybody more and more to just put all the retirement money, all their savings money into Roth accounts so they can tax them now. But that's not really a bad deal. It really isn't, because most people think, well, what's going to happen to taxes going forward? And when I ask that question with new clients we're introduced to, who are friends of our existing clients or people we meet through other events, I would say, what do you think 5 years from now, 10 years from now? Do you think tax rates and what you pay in tax are going to be the same, be higher, or be lower? Most people reluctantly say, I think they're going to be higher. So if they think they're going to be higher, then today, really what's going on is we're in a really lowest tax environment we're ever going to be in. We're a member of Ed Slott's elite advisor firm. In a group, we get together all the time. And Ed Slott, if you've seen him on PBS, always says taxes are on sale. That sounds kind of strange, but they really are. So if you think taxes are going up and you want to figure out how you can pay the least amount of tax on your tax-deferred money, give us a call here at Cornerstone Retirement Partners, 616-301-2581. 616-301-2581. Ask for me, Ron Corser, or Nolan Gosley. We can help walk you through the steps of how do you create a rational Roth IRA strategy, both a conversion and kind of a contribution level, to make some sense out of all of it as part of your retirement income plan. It's really critically important. So if it's important to you, it's going to be really important to us. Give us a call at 616-301-2581, or please go to our website at Cornerstone Retirement Partners. That's www.cornerstone-rp.com. Put your information in there. We'll reach out to you, contact you, give you the information you need to make really good decisions for you and your family.
Ron, all of those are obviously impactful changes for those planning and preparing for retirement that they would apply to. Doesn't apply to everybody, but for those that they apply to, it could make a significant difference. And that's really the way a lot of these provisions of the Secure Act 2.0 are applicable. I think the Secure Act first version was more wide sweeping, but this one is more beneficial for certain caveats and carve outs. Are there any other big provisions of the Secure Act 2.0 that we need to know about?
I'm going to touch on two of them, and there's a lot of them, but these are two I think are most relevant. There's something called a qualified charitable distribution, QCD. And what it is that when you get to be 70 and a half, you're allowed, if you're taking RMDs, requirement distributions, you're allowed to send all of that requirement distribution to a charity of your choice, any 501c3 corporation. We have more and more clients that are taking advantage of this. This is how it works. Let's say you have a required minimum distribution of $5,000 and you already have a giving heart and you're tithing to charities or churches. Rather than pay tax on that RMD because you have to take it out, a lot of clients are moving that money into a charitable qualified distribution, meaning they can give it to a charity of their choice. It does two things that are an advantage for you. Number one, it satisfies your required minimum distribution for the year. And number two, you don't even have to take it and use it in your income tax planning because it never shows up as income. So you get to do two things really well. You get to take your RMD, which you would have had to take anyhow, and you get to send it to a qualified charity. You get a deduction, meaning that income just never shows up on your income tax return. And if you're tithing anyhow, why not do it? I tell people, I'd say, I don't think Jesus would mind if you get a tax deduction what you give to the church. I don't think he would mind that at all. So that's an advantage. Now, there's another little thing that's come out here recently with what's called a charitable distribution, meaning you're allowed now to make a one-time, if you're 70 and a half or older, you can elect a qualified charitable distribution, a one-time gift up to $50,000 for a charitable remainder unit trust, a charitable remainder annuity trust, or a charitable gift annuity. So what this allows you to do is to take on a one-time basis an additional $50,000 out of your tax-deferred account, put it into some sort of charity account, which would give you income, but you get a tax deduction for it too. So that's a kind of a nice little thing for those who really don't want to just get taxed on their money and give it to the government. Now, if this is important, give us a call here at Cornerstone Retirement Partners, 616-301-2581, 616-301-2581. We can help walk you through the steps on how this works and how it might apply to you. Then there's one more I want to touch on because I think it's interesting. It's called these old Section 529 plans, where grandma and grandpa or aunt or uncle parents can put money into a 529 plan, which in essence allows a child to take that money out tax-free when they go to college. Sometimes that money's not used up, and it's been a burden. What do I do with it? Well, they put in this Secure 2.0 Act. Now you can take up to $35,000 if you have a Section 529 plan that's not going to be used, and you've held that plan for over 15 years. You can roll over up to $35,000 into a Roth IRA. That's really a unique little benefit. It really is. And I encourage anybody out there listening, if you got one of those old 529 plans that's never been used up, and you've had it for more than 15 years, give us a call. It's 616-301-2581, or go to our website here at Cornerstone Retirement Partners. It's Cornerstone Retirement Partners. It's www.cornerstone-rp.com. Put your information in there. We'll give you more information on how this kind of unique little subset of benefits can apply to you and really help you.
Always a pleasure getting to speak with Ron Courser, CFP, staying up to date on these financial investment and retirement planning law changes, the enactment of Secure Act 2.0, widespread changes to many different aspects in our financial and retirement planning. To know where they apply to you and where you may have opportunities to take advantage of, get in touch with the team from Cornerstone Retirement Partners. 616-301-2581, 616-301-2581, or cornerstone-rp.com, cornerstone-rp.com. And Ron, I know that the Secure Act 2.0 was several thousands of pages long, so still digging through it. We may come back and do some more episodes on other unique provisions.
You know, every time the government has a plan that has kind of an interesting name on it, like secure or protection or something, you always have to kind of really look at the fine print to find out exactly what they mean by that. So, ladies and gentlemen, give us a call here at Cornerstone Retirement Partners, 616-301-2581. ask for me. I'm Ron Corser or Nolan Gosley. We will help you sort through this maze of new rules and regulations so that you can take advantage of them and be farther ahead than you were yesterday or last week. So give us a call, 616-301-2581. Look forward to talking with you again soon.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.